In this video, we'll understand Schedule M1 for an S corporation and how it helps reconcile book income to tax income. Let's begin with the profit and loss statement prepared as per books, which reflects the company's financial performance. This is based on accounting principles, not tax rules. We have total revenue of $2.16 million and total expenses of $1.67 million, resulting in book income of $495,000. This book income is what you see in financial statements. But this is not what we report for tax. This $495,000 becomes our starting point for Schedule M1. But for tax purposes, several adjustments are required. Tax laws and accounting rules do not always align. Certain expenses allowed in books may not be deductible for tax, and some income recorded in books may not be taxable. Schedule M1 helps us bridge this gap. Let's first look at additions. These are expenses recorded in books but not fully deductible for tax purposes, so we add them back to book income. For example, entertainment expenses are fully disallowed for tax. Meals are only 50% deductible. Fines and penalties are also not allowed as deductions. These need to be added back. Certain expenses like warranty provisions or accrued bonuses are allowed in books based on accrual accounting. But for tax, they are only allowed when actually paid, subject to conditions. So these are also added back. In this case, prepaid rent received is not recorded as income in the books. But for tax purposes, it is taxable when received. So we add this as well. Now let's look at subtractions. These are items included in book income but not taxable, or additional deductions allowed for tax. For example, municipal bond interest is tax exempt. Life insurance proceeds are also generally not taxable. So we subtract these from book income. For depreciation, tax rules allow accelerated methods like MACRS. This often results in higher depreciation for tax compared to books. So the excess depreciation is deducted as a subtraction. After considering all additions and subtractions, we reconcile book income to tax income. This is the core purpose of Schedule M1. After all adjustments, the ordinary business income comes to $457,860. This is the taxable income at the entity level for reporting purposes. S corporations are pass-through entities. There is no tax at the entity level. The shareholders report this income on their individual returns. This income is reported on Form 1120-S and then allocated to shareholders through Schedule K1 based on ownership percentage. Some items are reported separately because they may affect the shareholders differently. These are called separately stated items, such as charitable contributions and tax-exempt income. These items retain their character when passed through to shareholders. These items are separated because each shareholder may treat them differently on their individual tax return. Here we can see how the income and deductions are reflected on the Form 1120-S, leading to the final ordinary business income. To summarize, book income is not the same as ordinary business income. Schedule M1 helps bridge that difference. Income flows to shareholders via Schedule K1. Understanding this flow helps you connect financial statements to tax reporting in a structured way. This video is for educational purposes only and is not tax advice. Watch the full series for more examples and deeper understanding.